If you walk into a bank today to buy a home, a mortgage lender might look at your paperwork and tell you, congratulations, you qualify for a $500,000 home. Do not celebrate. Because what a bank says you can legally borrow is completely different from what you can actually afford without living on ramen noodles for the next 30 years. Lenders don't care if you have money left over for travel, retirement, or childcare. They only care if you can pay them back. But behind closed doors, they use a strict mathematical formula to find your breaking point. It's called the 2836 rule. And today, we're going to use it to find your actual house budget. Open up the Notes app on your phone right now because we're doing the math together. Step 1 is simple, but it comes with a massive hidden trap. I want you to write down your gross annual salary. That's your income before taxes are taken out. If you make $80,000 a year, write that down. Now, divide that number by 12. If you're doing the math with me, that gives us roughly $6,666 a month. Now, here's the trap. Why do banks use your pre-tax income when you don't actually get to spend pre-tax money? Because tax brackets change, but your gross income is a stable baseline. Just remember this number. In your Notes app is a fantasy number. Uncle Sam hasn't taken his cut yet. This brings us to the first part of the rule, the 28% rule, also known as your front-end ratio. Lenders state that your total monthly housing costs should never exceed 28% of that gross monthly income. Let's do the math. For our example, $6,666 times 0.28 equals $1,866. So, according to this part of the rule, your maximum monthly housing payment is $1,866. But wait, what does housing payment actually mean? Most people think it just means the mortgage. It doesn't. Lenders look at something called PITI. P, principal, the actual loan. I, interest, the cost of borrowing. T, taxes, property taxes. I, insurance, homeowner's insurance plus HOA fees. Principal, interest, taxes, and insurance. If your base mortgage payment is $1,500, but your local property taxes and insurance add another $400 a month, your total housing cost is $1,900. You just blew past the 28% ceiling, and a strict lender will flag your application. But the bank isn't done. Now we hit the second half, the 36% rule, or your back-end ratio. Lenders mandate that your total monthly debt payments, that's your new housing cost plus all your existing minimum debt payments, cannot exceed 36% of your gross income. Let's take our $6,666 gross income again and multiply it by 0.36. This means your absolute maximum debt allowance across your entire life cannot exceed $2,400 a month. Now, let's see how your real life squeezes that budget. Look at your Notes app and write down your monthly minimum payments for your car loan, your student loans, and your credit cards. Let's say you have a pretty average setup, a $350 car payment and a $150 student loan payment. That's $500 in existing monthly debt. Watch what happens to your house budget now. We take that 36% limit of $2,400 and subtract your $500 debt. It's $1,900. The bank looks at both numbers, the $1,866 from the front-end rule and the $1,900 from the back-end rule, and they always choose the lesser of the two. So your absolute maximum PITI payment is $1,866. But watch what happens if your car payment was $600 instead. Suddenly, your back-end budget drops to $1,650. That shiny car just permanently slashed your ability to buy a home by hundreds of dollars a month. This is exactly how people trap themselves before they even talk to a realtor. Now for the ultimate reality check. The 2836 rule is what the bank allows you to do. It is not what I recommend you actually do. Remember, this is based on your pre-tax income. If your monthly take-home pay after taxes and healthcare is $4,800 and your mortgage PITI is $1,866, that means nearly 40% of your actual cash is vaporized by housing costs every single month. Add in groceries, utilities, and gas, and you are officially house poor. You have a beautiful home, but you can never afford to leave it. If you want to sleep well at night, aim for a conservative golden rule. Try to keep your total housing payment under 25 to 28% of your net take-home pay, not your gross. What did your numbers look like when you did the math? Did the bank's rules surprise you? Let me know in the comments below. Smash the like button if this made the math simple, subscribe for more real financial breakdowns, and I'll see you in the next video. Peace.